Hello and welcome to this session brought to you by the Academy of Practical Accounts in conjunction with your institution. In this session, we'll look at allowed and disallowed expenses. The objective is to examine the conditions regarding what should be classified as allowed and disallowed expenses. Condition number one, there has to be a supplier receipt or invoice to prove it was incurred for business purposes. If there is no invoice or receipt, then it's not allowed. We can't pick them from our heads. There has to be a document to support that. Number two, the expense should not have been made for personal or domestic use. Expenses for personal or domestic use are referred to as drawings. Now, anything to do with expense, some people include the cost of maintaining a nanny. That is a personal expense. It's not a business expense. A business has got nothing to do with a nanny. A business is an establishment set up for the purpose of making profit, not generating children and looking after them. Okay. Now, number three, it should not be a capital expense or the purchase of a fixed asset. In the case of a fixed asset or a capital expense, the expense equivalent is what we regard to as a capital allowance or a tax allowance. The depreciation arising from fixed assets is not allowed for tax purposes. Number four, it should not be a fine or penalty for breaking the law. A common example are parking fees. They may be recorded as a business expense because a business vehicle was parked in the wrong place, but the law disallows them as business expenses. So when we are adjusting the business profit for tax purposes, we are supposed to add back penalties for breaking the law. So even costs for going to court to defend the business regarding penalties or breaking the law, they are disallowed for tax purposes. Number five, it should not be a commuting expense between home and the usual place of work. For the unusual place of work, it's allowed. It's allowed. Okay? Transport, accommodation, meals, all that is allowed if you're going to an unusual place of work, business trip, and so on. But if it's a common, usual, daily routine, then it's not allowed for tax purposes. Now, number six, it should not be for clothing usable outside work. It should be clothing that is directly related to work. Anything outside that is not a business expense and is disallowed for tax purposes. Well, if a suit is bought for business meetings, it's a little bit questionable. It is questionable. Now, number seven, in case of an education cost, it must be relevant to that person's employment. If an individual is employed as a bookkeeper in a business and then he undertakes a legal course, a course in law, they want to become a lawyer, then that expense is not allowed for tax purposes because what they are studying or training for has got nothing to do with their employment. That's as far as the law is concerned. Now, meals and refreshments are disallowed except if they are on business travel or they are provided on business premises or they are provided by an outside supplier on behalf of the employer and they are available to all full-time employees on equal terms. If there is something special for particular employees, then it's not allowed. So the allowed meals and refreshments should be for all and within business premises normally. Now, number nine, interest is only allowed if it's paid on money that was borrowed for business purposes. If the money was borrowed for personal purposes, the interest on that money is not a business expense and it is disallowed. to be on the safe side, disallowed expenses should not be recorded, except in the case of a sole trader. Actually, let's have a quick look at the chart of accounts. In the case of a sole trader whose turnover is above 82,000, there is room to record disallowed expenses. For example, account 42. You can record disallowed expenses, and on the tax return, they are exposed and added back for tax purposes on the tax return. So we've got 48 for subcontractors disallowed, we've got 61, we have got 78, we've got 94, we've got 104, we got 119, we have 138, we have 150, we got 163, and then we got 177. That is for a business whose turnover is above 82,000. But for that one whose turnover is below 82,000, they should not record disallowed expenses at all, because there is no provision for adjusting them. It's a simple business scenario. The bigger businesses can do that, and then there is room on the tax return to remove that. We're not looking at the tax return yet. We shall look at that a little bit later. Okay. Now, number 10, sole trader wages are disallowed. Taxes, national insurance contributions, pay, pensions, etc. And all these should be regarded as drawings. They are disallowed for tax purposes. Now, instead, what the sole trader takes from the business is the surplus that remains after paying taxes, because the business generates a profit. From that profit, a tax is paid, and whatever is left can be taken by the business owner. However, they can take money before the year end, before the final year profit is calculated in form of drawings. That is acceptable. But these are not business expenses. Now, number 11, we're looking at non-business driving travel costs or personal motor expenses. They are disallowed. They have got nothing to do with the business. These are personal motor expenses, driving expenses, or travel costs. They should not be recorded in business records. So we are looking at the business entity concept, whereby we try to separate personal and business matters. Now, number 12 is to do with improvements made to premises costs. Now, if the cost is 1,000 and below, then it can be accepted as an expense. But if it's beyond 1,000, then it should not be an expense, but instead become an increment in the value of the fixed asset, and it's only written off gradually on an annual basis in form of a capital allowance or tax allowance. Now, number 13 looks at repayments of loans and overdrafts. These are not business expenses. This is money owed by the business. When the money borrows the loan or overdraft, it's not an income. It doesn't increase the profit. It doesn't increase the tax. And when it's being paid back, they are not expenses, but a debt that is simply being paid back. Now, number 14 says that a bad debt is only allowed if it was initially a sale, whereby the debt recovery was not successful. So in that case, it can be written off as a bad debt. However, this is only allowed to limited companies, not to sole traders. This is a little bit confusing. Well, I'm looking at this is reference to the HMRC website. And then number 15, of course, we'll have some variations to these regulations in different countries. There are variations, though they're small, they're quite small. Now, number 15 looks at a donation. A limited company can donate to a registered charity. and it's allowed as a business expense. But a sole trader should not. That is what the law says. In different countries, it could be different. And then finally, limited companies can entertain customers or suppliers, provided the amount spent on each person is £50 or less per year. That is acceptable. And this is only allowed to limited companies. Sole traders are not allowed to entertain customers or suppliers. That's how it stands. So, this is a brief look at allowed and disallowed expenses. 70% of these should be global. So, the 30% is where we may have small variations. Actually, up to 85% should be the norm in all countries. So it is a small 15% that may be variable in various countries. So that brings us to the end of this session where we looked at allowed and disallowed expenses. In case of any questions, please, you'll get us by email and Skype. Thank you.